Investing can sometimes feel like navigating a complex maze, especially when it comes to exchange-traded funds, ETFs. One such player in the game is the Vanguard High Dividend Yield Index Fund ETF, ticker symbol VYM. It is known for its hands-off approach in building a passive income stream. But hold on, it's not the only player on the field. In this video, we'll delve into a comparison of VYM with some heavyweight competitors, exploring their total return records, dividend yields, expense ratios, and portfolio compositions. The competitors we will be looking into are the JP Morgan Nasdaq Equity Premium Income ETF, ticker symbol JEPQ, JP Morgan Equity Premium Income ETF, ticker symbol JEPI, Amplify CWP Enhanced Dividend Income ETF, ticker symbol DIVO, Schwab US Dividend Equity ETF, ticker symbol SCHD, SPD, our portfolio S&P 500 High Dividend ETF, ticker symbol SPHD, and finally, Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD. Now, you try to say that 3 times in a row. Get ready for a comparative exploration into the world of investment options that might just shape your financial journey. Before we dive into the comparison, let's take a very quick detour to understand what ETFs are. ETFs, or exchange-traded funds, are like baskets of stocks, bonds, or other assets that you can buy and sell on the stock exchange. They offer a way for investors to spread their investments across a variety of assets, providing diversification and, in the case of dividend-focused ETFs, a steady income stream. Over the past year and a half, VYM has shown resilience, weathering headwinds with a total return of around -5%. While it may not have outshone all its peers, it held its ground against the competition. JEPI and DIVO surged ahead, fueled by the tech stock boom. VYM might not be the fastest horse in the race, but it's certainly not lagging. Over the longer term, VYM has performed pretty well against the funds that have been around since then, outperforming all other competitors and trailing SCHD. Moving on to the dividend yield and their compound annual growth rate, otherwise known as CAGR, VYM's trailing 12-month dividend yield and 5-year dividend per share CAGR is solid, with a TTM dividend yield of 3.27% and a respectable 5-year dividend CAGR of 5.6%, indicating that its income stream is growing faster than the long-term rate of inflation. In contrast, JEPI and JEPQ have very inconsistent payouts due to the lumpy nature of their options premiums, which account for the vast majority of the cash flow that they distribute to shareholders. That being said, both ETFs offer high current TTM dividend yields, with JEPQ at 10.94% and JEPI at 9.26%, which are substantially higher than the other ETFs, making them potentially attractive for investors seeking current income. SCHD stands out with the highest 5-year dividend CAGR at 13.69%, paired with a TTM dividend yield of 3.77%. which suggests that investors in SCHD have enjoyed significant dividend growth alongside a yield that is above the average for U.S. equities, making it an exceptional dividend growth ETF. On the lower end of the dividend growth spectrum, SPHD and DIVO have 5-year dividend CAGR of 2.49% and 2.61%, respectively. While these growth rates are modest, they are generally in line with long-term inflation averages and come with very attractive TTM dividend yields of 4.8% for SPHD and 4.91% for DIVO, making them attractive sources of current income. Finally, SPHD is quite similar in its growth and yield profile to SPHD and DIVO, with its 5-year dividend CAGR of 2.72% and a TTM dividend yield of 5.24%. Expense ratios are a critical factor to keep in mind when evaluating an ETF because they directly impact an investor's net returns, especially over the long term. Even a seemingly small difference in expense ratios can have a significant effect on an investment's growth potential over time due to the compounding effect that it has year after year. Over the long term, a higher expense ratio can consume a considerable portion of a fund's gains. Therefore, a lower expense ratio is often seen as a competitive advantage for an ETF, especially when compared to another ETF that has a similar investing strategy. Both JEPQ and JEPI have moderate expense ratios of 0.35%. While this is one of the higher expense ratios in this list of ETFs, it is important to keep in mind that both JEPQ and JEPI are actively managed and generate significant cash flow through options trading, thereby warranting some of the additional fees that investors pay for access to the services that these ETFs supply. In comparison, the Amplify CWP Enhanced Dividend Income ETF, identified by its ticker DIVO, has an even higher expense ratio of 0.55%. This is not entirely surprising given that DIVO is also actively managed and trades some options as well, so it generally has more operating expenses than passively managed ETFs. On the more cost-effective side, passively managed ETFs like SCHD feature very low expense ratios. SCHD has an impressively low expense ratio of 0.06%, making it an attractive choice for investors who prioritize cost savings for long-term compounding. SPHD's expense ratio is only slightly higher at 0.07%, while SPHD has an expense ratio of 0.3%, making it a bit pricey for an ETF with fairly similar results to the cheaper passively managed funds. In comparison, VYM's expense ratio of 0.06% matches SCHD as the lowest among the ETFs in our list and one of the cheapest ETFs in the entire market, making it a compelling choice for investors who want to retain as high of a percentage of their earnings as possible. VYM adopts a diversified approach, favoring sectors known for stability and dividend yield. Financials lead the pack at 19.8%, followed by consumer defensive 14.4%, healthcare 13%, industrials 11.9%, energy 11.3%, and technology 9.7%. This balanced mix signals an intent to combine growth and income. When it comes to top holdings, VYM boasts large and established businesses. ExxonMobil leads with 3.3%, followed by JP Chase, Johnson & Johnson, Procter & Gamble, Broadcom, and the Home Depot, among others. These top 10 holdings make up 25% of the fund, indicating a focus on consistent dividend growth. Comparatively, JEPQ heavily leans towards technology of slightly above half of its entire holdings, with a more concentrated top 10 holdings of around 47%. JEPI shows a notable tilt to technology and healthcare, while VYM stays grounded in financials, consumer defensive, and healthcare. SCHD takes a bold stance with industrials as the largest sector with nearly 18% and a concentrated top 10 of around 40%. SPHD emphasizes financials and real estate, deviating from VYM's exposure. Its top 10 holdings represent around 15%, showcasing a more spread-out approach. DIVO, with a tech-heavy portfolio of 18%, is heavily concentrated in its top 10 holdings with a whopping 60%. SPHD, with utilities leading 17.86%, has a modestly more invested top 10 of 28.2% compared to VYM. Every ETF has its unique approach to diversification and management. It's crucial to identify the management style that aligns with your specific needs and preferences. VYM emerges as a strong option for investors aiming to construct a diversified and cost-effective passive income stream. The analysis underscores VYM's resilience in total return performance and commendable dividend yield and growth. While VYM holds its ground, alternatives like JEPQ and JEPI boast higher current yields backed by active management, a potential justification for their higher expense ratios. On the other hand, SCHD presents itself as a formidable contender, showcasing impressive dividend growth, a comparable expense ratio, and a noteworthy yield, particularly attractive for those with a focus on dividend growth. Meanwhile, SPHD, SPHD, and DIVO cater to investors seeking immediate income, albeit with lower growth rates. It's important to note that JEPI and JEPQ may offer sky-high yields but with inconsistent payouts. VYM's strength lies not only in its performance but also in its exceptional diversification, fostering a lower risk profile over the long term compared to its counterparts. While VYM may not be the optimal choice for those prioritizing maximum current income or rapid dividend growth, it excels for investors seeking a balanced approach. With a very low expense ratio and substantial diversification to mitigate company-specific risk, VYM remains an excellent choice for those looking for a harmonious blend of income and growth. If you found this information helpful, don't forget to like and subscribe to my channel for more insightful content. Your support is invaluable.